Okay, so now it's recording. Okay, so what I'm going to do is go right to um, the canvas, and I'm going to give you a new share. So let's see. Okay, so now you should see like a bunch of boxes and a piggy in the corner. So we're going to go to Managerial Accounting, and we're going to go to Assignments. Before I start, did you either of you have questions? No questions, Nigel? Hendrik, I can't see you. Can you show yourself or not today?
My room is.
Who cares?
Mm,
Look at my room. It's a mess. I don't
uh,
think I'm looking at that. I'm happy you're here. You do whatever's easy for you. I'm not gonna make you feel uncomfortable. So, any questions you have? If time permits, hi Cayman. If time permits, we'll do the PQ. Could someone be kind enough to tell me which PQ is up and coming? I'll tell you
mhm.
which one I think it is. And, like, I'm not perfect, but I always look to you guys. I'm thinking the next one due is PQ7.
It's next one is November 12th, PQ9.
Oh, PQ9. Why don't I see it here? Oh, okay.
I believe
Oh, okay, good. PQ9. Okay, so if time permits, we're going to do PQ9. All right. So let's
Okay.
start with RA11. Let's start with RA11. We're going to go right to Canvas and do it right in Canvas. So does everybody have a notebook handy? Do all of you have a notebook handy? Give me in the chat box. You could just give me a raising your hand. Hi, Cayman. Hi. Hey, Cayman. Good to see you. Good to see all of
Let
you,
me go get a
actually.
notebook.
I look forward to these meetings. So I'm so happy to see all of you. So let's go here. And I think this one is due the 17th. So you have time, but why not be ahead of the game? Listen, if you can get it done and out of the way, isn't that a good thing? All right. So I'm clicking on preview and we're going to go through this. All right. So let's see. So all right, let's see. I think I already did this one, so it's not letting me go in it again. Oh boy. All right, we'll go through it and we'll just do the best we can. So, all right. So the process by which management plans, evaluates, and controls long-term investments, meaning they last. Who's making all that noise? Is that you, Hendrik?
Um, no, I don't think so.
Okay, maybe it's me. Um, oh, I forgot what I was going to say. So when you buy a long-term investment, it could be an airplane. If you work for an airline, you might invest in an airplane. That's a long-term investment, right? You got to fly people around. So anything that has a future life, a future benefit beyond a year is an asset, but it's a long-term asset versus cash, which is very liquid and goes in and out of your hands very quickly. So that's a liquid and current asset. And so is accounts receivable. These are current assets. And these assets are listed, I think I've mentioned before, in the order of liquidity. How liquid are they? Cash, of course, is king. It's liquid. I can go buy myself a hot dog if I have cash. Whereas if I owned an airplane, I have to sell it to someone, maybe President Biden, and then I
Yeah,
could have cash. No, I'm kidding.
you need a fence.
I know. I don't even want to talk about it. But anyway, so the answer to this is capital investment. But let me just tell you that this is on page 524. This is on page 524. Let me see if I can show my version. I don't really want you to see the answer. I mean, I'll tell you, we'll go over the answer, but I don't really want you to see it because it's going to distract you. All right. So the process of this is called capital investment. So if you look on page 524, if you have your book with you, I took out the chapter. The book was too heavy. It was hurting my legs. So I took out the chapter and stapled it. It's just too much. It's a heavy book. So it says here that companies use capital investment analysis to evaluate the long term investment. So in other words, they can't just wake up one morning and say, I think I'll buy a plane. They have to put together some reports that justifies this decision. That's what they have to do. And capital investment analysis, or capital budgeting, they call it, is a process by which management plans, evaluates, controls investments in fixed assets, which is exactly the wording of your question, taken right from your book. And believe me, these capital investments affect the operations for many years and must earn a reasonable rate of return. So when I buy this plane, I better be transporting a lot of people so that I cover the cost of what this plane cost me and justify the fact that I made such a huge expenditure. Does everyone kind of get that message?
Yeah.
I mean, it could be as simple as you starting a landscaping business and you decide to buy a sit-upon mower. I don't know how much those things cost. Does anybody know? Cayman, Hendrick, Nidell?
I have no idea. All I know
What are
is
what costs?
One of those sit-upon lawnmowers. The ones you sit on.
Probably like upwards between like 5 and 15 grand.
Yeah, I think you're right, depending on how many bells and whistles. So I have to justify, can I mow enough lawns to justify my spending $15,000 on the sit-upon mower, or should I just buy an inexpensive gas mower that's going to cost me $200 at Home Depot, and therefore I know I can make up that $200 and then some, but I'm going to have to put some of my own brute force into it. You follow it, all this business of how to, how a manager might think? Okay, so the answer to question one is capital investment analysis, which is the chapter's title. It's the title of the chapter. So sometimes the answer is right in front of your face. So let's go. Anybody have any questions before we go to two? Wait a minute, did I lose anybody? Oh, Hendrick is still there. Okay, I thought I lost somebody. Any questions before we go to two? Okay, very good, Nigel. All right, so there's methods to the madness. There's methods of evaluating the capital investment proposals, and they're separated in two general groups. There's present value methods, where we use those tables. Remember the present value tables? And which answer do you think is the correct answer? Past value methods, straight line methods, reducing value methods, methods that ignore present value. The answer is on page 524 if anybody's interested.
Ignore.
Yeah. Methods that ignore the present value. So there's these methods that do the present value, and there's two. The average rate of return method, and there's the cash payback method. Then under the guise of methods that use present value, there's the net present value method and the internal rate of return method. So altogether, there's four methods, but there's two categories that each, or two buckets that these methods fall into. Okay, so how many methods are there in total? Give me a show of hands or type it in the box there. Or hold your hand. Yes, four. Very good. I see
Four.
a smiley face. Good job.
Sorry, I didn't.
No, that's fine. I love it. The action. I'm thrilled.
I meant to put a thumbs up.
I'm talking to myself here. This is okay. Very good. Very good. The answer, it was correct. Methods that ignore the present value. That's correct. Good job. So here comes question three. The expected average rate of return for a proposed investment of 800,000 in a fixed asset with a useful life of 4 years using the straight line depreciation, which means we do the same every year. So if we were to graph it, it would graph a straight line, hence the term straight line.
Gotcha.
Yes. So I'm trying to make you understand why we come up with these names. So no residual value. Remember how we talked about residual value? So in this case, we're not having to deal with that. And the expected total net income is $360,000 for 4 years. So they want us to know the expected average rate of return. So let me see if I can use my blackboard here. I'm going to try. I moved it close to me, and I'm hoping you could see it. So let me take this. It's not a blackboard. It's actually a whiteboard. Anybody watch the show called The Chris Lee's Knows Best? Anybody watch that show? Chris Lee's Knows Best? No? It's hysterical. I can't stop watching it. It's so funny.
Is it on Netflix?
It's on Amazon.
Oh, okay.
It's also on Peacock, but I don't even know how to get Peacock. But somebody said it's on Peacock. So here is, we have to, before we can bake the cake, what do we need? What do we need before we can bake a cake? Unless we're really talented.
The ingredients?
Yeah, the ingredients. We need the ingredients. We need the recipe.
Or the formula in this case.
Yeah, exactly. So let's see what the, hold on a minute while I get it. Just bear with me. I'm going to write it on the board. Let me know if you can't or cannot see it. Because if so, we'll have to do something else. Okay, so the average investment, that's what we're trying to figure out. Average investment. Can anybody see what I'm writing, or is it too far away? Can you see that?
For this question, we were doing average rate of return, number 3.
Yeah, can you see that, or it's kind of got a light on it? Let's see if I can pull this closer without hitting myself in the head. Can you see it now?
Yeah.
Yeah, but for number 3,
Yeah.
I'm pretty sure we're using
Can you see?
average rate of return.
Or is the light getting in the way? Let's see if I can move the light a little. How's that? Is that better? Can you read that? Everyone? Yeah. Oh, good job, Nigel. Okay. So average investment equals, parentheses, I got to make sure I'm staying within, parentheses, initial cost, and let's see what the initial cost is. The initial cost of the thing is $800,000, right? The initial cost is $800,000. And then what do we do next? We have to add the residual value. What's the residual value?
0.
Yeah, good. So it's 0. Good. That's 0, so that's it. And then what do we do next? We have to divide by 2. Why do we have to divide by 2? Because it's an average. Average. All right? So if we divide by 2, 800,000, see that? I'm trying to see if you're within my shot. Okay, 800,000 divided by 2 is going to equal 400,000. All right, let's see what comes next. Then we have to take the estimated average annual income. Let me see. Can you see that low? Estimated average income equals the estimated average annual income. You have to get annual, which is 360,000. Does everyone see that? 360,000. They gave us that number. And then we have to divide that by how many years to get it per year? How many years are there?
4?
Yeah. So that's 90,000. Do you agree? Do you agree?
I'm sorry, what did you say?
So it's 90,000 if you divide 360,000 by 4 years.
Oh,
Let me type. I'm going to put it in the chat box. Does everybody can see the chat box?
yes, that's
Right, so
90,000.
divided by 4 years, and that equals 90,000. Okay. And after we get that, we take the 90,000, the average estimated annual income. We take the estimated annual, so it's 3 steps to this computation. Estimated annual income, which we said is 90,000. We computed that in step 2, and we divide that by the average investment, which we did in step 1, which was, how much was that? It was 800,000 divided by 2, remember?
Yes, 400,000.
Yes, that's 400,000. So what is 90,000 divided by 400,000?
Oh boy. I need a calculator.
Let me get mine too. I gotta get mine too. The answer is going to be in a percent. The answer is going to be in a percent. You know, I bought a little box because I couldn't find my calculators. All the time I kept misplacing them. So I bought this little box. And now I put all my calculators in here so I can find them. Otherwise they get lost under paper and what have you. So here we go. So we take 90,000 divided by 400,000. Put your answer in the chat box. In the form of a percentage. You have to move the decimal 2 places to get the percentage because you're going to have point, bop, 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 and then you move it 2 places to get bop, bop, dot, bot, percent. Yes, good job. Good job, Hendrik. Excellent. Very good, very good. All right, well, right answer. So do we have that as a choice? Here it is right here, 22.5. So there's 3 steps to doing that. Very involved. All right, let's do number 4. Let's do number 4. Let's scoot down to 4. So Hayden Company, do I have to make this bigger? Can everybody see, or is it too tiny?
I can see it.
You can see it. Hendrik came in. Nidal, did you see this? I don't know if I can make the screen bigger. I'm looking for the thing on the bottom, you know, that thing you move back and forth so it gets bigger or smaller.
It's good. I can see it.
Oh, I'm so happy to hear that because I don't know how to make it bigger. So Hayden Company is considering the acquisition of a machine that costs $675,000. The machine is expected to have a useful life of 6 years. This is an estimate. This is not actual. The machine might last 60 years. We don't know. I'm being facetious. It could last 12 years. We don't know. But they're estimating based on what they think they're going to use it, it's going to last 6 years. And they feel like that the results of what's left over after 6 years, it will have no real residual value. It'll be junk at that point. And the annual net cash flow of $150,000 and annual operating income of $87,500. What is the estimated cash payback period for the machine? All right, so let's see. And that's going to be in terms of years. The answer will be in years. So let's look on page 526 of our book. And let's look how to compute this cash payback thing. I'm looking for a tissue so I can erase my board. All right, so let's see. Oh, here it is. It's at the bottom of page 528. So here's the formula for this particular type of calculation. So the cash payback period equals initial cost over annual net cash inflow. Can you all read that? Are you able to read that, or should I have to move it or something? I have to move it a little bit. I'm trying to see. I think I gotta move it back.
Oh, that's good right there.
You can see it? Okay, good. So let's see. Let's go down here and see how this formula works. I'm going to put it in the chat box maybe, just so you have it in 2 places. So the cash payback.
I already have the.
Oh, you have the answer? Okay, great. What's the answer?
No, I was gonna say I already put the
Oh, thank you, Cayman.
equation in the chat.
Yeah, because I got so much going on here. I can't even find the keyboard. All right, thank you. So here it is here. So I put these new things. I decided that I would give all of you like an explanation to the correct answer when you do the quiz. Because if you do the quiz and you get the right answer, sometimes you don't know why you got the right answer. So I started typing it. Let me know if you like this or don't like this because it takes me time. But I think I would like it if I was a student. So I put the formula and I put what page you can find it on. So basically, the initial cost was $675,000, and each year they told us they make $150,000. That's their estimate. If we divide these two numbers, what's the answer in terms of years? I got 4.5 years. What did you all get? What did you all get?
2.5.
Yeah, good. So that's the correct answer. Very good. Very good. So this is called the cash payback period. All right, the cash payback period. Very good. So let's go to question 5. Once you know the formula, isn't it easy? It's the whole idea of knowing which formula to do for which problem. That's where it gets confusing. So using the follow, Nidell, are you at school? The school's opened?
This is the library for HCC. I had a music lesson.
Oh, so in other words, the library is open because I was curious to know what's going on the campuses. So 5, using the following partial table, the present value of 1 at compound interest, the present value of $15,000 to be received in 3 years with an interest rate of 6%. So you have to go down to 3 years. Does everyone know how to use one of these things? You go to 3 years, then you got to go over to the column with 6%. So what number are we going to use, scholars?
0.84.
Yeah, exactly. We can't use just any number. We got to find the percent, the rate, and we got to find how many years before we can find the right rate. Very good. So let's see how we do this. This is called earnings. What is the name of this? We're finding the present value of $15,000 at 6%. If I put a certain sum of money in the bank today at a rate of 6%, what will I find when I go to the bank 3 years from now? I'm going to find $15,000. But what do I have to put in today to get that result?
I see.
If you see what I'm saying? So if I take this 15,000, what I want in 3 years, and times it by 0.840, what do you get?
12,600.
What did you get? Oh, yeah, yep, that's right. So if I put 12,600 in the bank right now, today, and I go back to the bank November 10th,
3 years.
2023, if I'm still alive, then I would find sitting there 15,000. Or my children would inherit that money if I'm not here to go get it myself. All right, so that's what that chart does. All right, so let's say you want to buy a car for 15,000 in 5 years. You could use that chart to figure out how long you have to, how much you got to put in the bank today in order to get the 15. So let's say if I have a rate of 6% and I want to put it in the bank for 4 years. So I want to have $15,000 in 4 years. So $15,000 times 0.792. I have to put 11,880 into the bank today in order to save up for my car in 4 years. That's how it works. Okay. So the answer is correct, $12,600. All right, here, any questions? Am I going too fast? So here comes question 6. So the management of Arkansas Corporation is considering purchasing a new machine costing $490,000. The company's desired rate of return is 10%. The present value of 1 at 10% for years 1 through 5. They give us the numbers off the chart. Do you all see that? 0.909, 0.826, 0.0751, 0.683. These all come off the chart. But you know what my advice to you is? When you're doing a problem like this, put it in Excel. Put it in Excel. So let me show you what I did. I put it in Excel so you could see it. Does everybody see my Excel sheet now? You all see it?
Yes.
What I did is I took year 1 through 5. They told me there was 5 years. So I put year 1 through 5, and you could see this on page, I'll tell you what page it's on in case you wanted to figure it out yourself. I want to say it's on page 542, but I'm not 100% sure. Let me just make sure. No, it's not on that page. Let me see. It's on page 532. It's on page 532, so I'll type it here. Page 532 in your book. That's where you find it. I left the 2 off. Okay, that's where you find it. Let me put it in yellow. So then I put all the numbers off the present value, but I had to pick the one at 10%, not just any numbers. Then they told me the cash flow for year 1 was 180,000. They told me for year 2, 120,000. Year 3, 100,000. Year 4, 90,000. And year 5, 120,000. And then I totaled it. Then I take this column and I times it by this column. You see that? And that's how I got the present value of net cash flow. Does everyone see how I did that? And what did I do next? How did I get this number here? The one that's in aqua. Well, let me say blue. How did I get the blue number? What did I do? I did a computation. I'll even click on it so you can see my computation up at the top. What did I do with those numbers that I computed once I got the present value of all those years?
Is it the sum of the present values?
Yeah, exactly. I added them up. So I got 473,830. Then I subtracted 490,000. Where did I get this number from? What's that number represent? The 490,000.
The initial?
Yeah, exactly. The initial investment, how much the thing cost. And when you have a machine that costs 490,000, not only does that mean the machine, it means the sales tax on the machine, it means the installation cost of the machine. So all these things together is the cost of the machine, not just the machine. All the things to make it ready to work. Okay? And then I subtracted. So what is my answer? It's a negative answer. Do you see my answer? I'll put it in orange. Do you see my answer in orange? So yes, 16,000, negative 16,170. So let's see, do I have that as a choice? Do I have that as a choice? Do you see that as a choice in this problem? Yeah, negative 16,170. But do you see how you kind of sometimes have to put it on a chart? You can't just read this and know the answer. I, as an accountant, I'm not a magician. I got to take these numbers and put them on Excel and figure them out. I can't just look at this and know what the answer is. It doesn't work that way. All right. Any questions? Was that too difficult? Hendrik, did I lose you?
Yeah, that was good.
You're okay. You're still there. You're good. All right, good. Here comes number 7. So which of the following, let me just make a space here because I'm a neurotic. Which of the following is not considered a complicating factor in capital investment decisions? They're saying not. Because there's a lot of things in making a decision, and I'll tell you what page that's on. They give you a list of what they consider factors. Let me find the factors if I can. Oh my goodness, why is it when I want to find something I can't? Just bear with me. Oh, here they are, I found it. So there's factors that complicate capital investment analysis. One of them is income tax. One of them is proposals with unequal lives. One of them is leasing versus purchasing, uncertainty, changes in price levels, qualitative factors, meaning the quality. So which one is not one of those?
Equal proposal live.
Yes, because they said it's unequal proposal lives. Very good. Very good. So that is the correct answer. Good job. So here comes number 8. All of the following are factors that may complicate capital investment analysis, except all the following complicate. Well, that's what I just read to you. So pick something that isn't on the list, and that's going to be the answer. So possible leasing alternatives. I read to you leasing versus purchasing. So that's on the list. Changes in price level. I read to you changes in price levels. So that's on the list. And then sunk costs. Was that on the list? Was sunk costs on the list? This is on page 537, by the way. That is delicious. Anybody ever try this ginger ale? It's got kick to it. I love it. It's really tasty. Red Rock ginger ale, delicious. If you had a bad stomach, if that ginger helps the stomach, it's really good. Just in case, because I know you guys are under stress, and little things like ginger ale could help you. So what do we have? What do you guys think? Which one do you think is not one of the complications based on what the book says?
Some costs.
Yeah, very good. A sunk cost is a cost that has been incurred, cannot be recovered. It is not a factor in the capital investment analysis. It is more of an after the fact cost that you cannot do anything about. Okay. So here comes number 9.
Can you hear me?
Can you, can, yeah, I can hear you,
Oh,
Henry.
okay. Sorry, my mic was, I don't know, it was acting weird.
That's okay. The process by which management, if I can't hear you or you think I can't hear you, then type in the chat box.
Okay, I just unplugged in, plug it back in.
Okay. The process by which management allocates available investment funds among competing investment proposals is called, so there's an actual process, and it's on page 541, how they go about allocating these investment funds. There's some sort of, step-by-step procedure. So what do you think that's called? It's at the bottom of page 541. What do you think that's called? The process of allocating funds by management.
Capital ration.
Yes, that's right. So capital rationing is the process by which management allocates funds among competing capital investment proposals. So say Cayman, he thinks we should buy a brand new copy machine, but Nidal feels we need a new color printer. It's more important. And Hendrik, maybe he thinks we need a new computer for the library. And so now we have to see whose proposal is better based on doing some what they call capital rationing. So here's the process. In this process, management often uses a combination of methods described in the chapter. So step 1, alternative proposals are initially screened by establishing minimum standards. So they use the cash payback method. They do the average rate of return method. Remember we learned those 2 methods? If anything passes those methods, it goes on to step 2. The proposals that survive the screening are further analyzed doing the net present value and the internal rate of return method. It kind of reminds me when I tried out for the cheerleaders. I made the first round. I passed the first set, but I hurt my leg in the process. So the next day when I tried for the second step, I didn't make it. So as so many years have passed by and I'm still thinking about that. But the good news is I married the captain of the football team, so it wasn't all a loss. You guys, I'm trying my best to get you to crack a smile, and I'm just not getting it. All right, we'll go on to question 10. So here we go. In capital rationing, the alternative proposals that survive initial and secondary screening are normally evaluated in terms of present value, non-financial factors, maximum cost, or net cash flow.
Net.
Non-financial factors have another way of saying them. They call them qualitative factors. Does anybody have an answer, or would you like me to give you the answer?
Oh, non-financial factors.
Yes, very good. Was that you, Hendrik?
Yep.
Yeah, very good. That's the answer. Good job. So that's all for that. So now let me ask you a question. Do you want to do PQ9? Because some of you already submitted that. Or good job. I like your hand, your thumbs up. Or do you want to do PQ10? Let me see a raising of hands. Who wants to do PQ10? Okay. Oh, good. Good, good. What about you, Hendrik?
For sure, yeah.
Okay, let's do PQ10. So that's exercise 10.4. Exercise 10.4. Let me get my book. Let me get my book out again. Could somebody read the problem for me? Could somebody read the problem so I don't have to go searching in my textbook? Exercise 10.4. I'm going to close out of here. I don't really want to close out of here. I just want to kind of go to the PQ. Let me see what I have. So it's managerial. What's good about your class, it's not a big class, and that really helps. You know, it helps me to be able to help all of you because with 35 students, it's very hard. But I think I only have 15 in this class, and that's a good thing. So here's PQ10. This is what you would see. To receive the best grade, okay, I get this whole thing. It's called Dish and Dat. Am I right on page 506?
Oh, PQ10.
Am I correct? Okay, because I want to make sure. Sometimes I've changed them. It's according to this, it's exercise 24. Does that make sense? So just make sure that I'm on the right one. That's all I ask. I'm going to do a new share when it comes up. It's not open yet. So let me do a new share. Okay. All right. Does everybody see the famous blue Cengage template? You all see that? Okay, good job. So this is something called differential analysis. We have two alternatives. Do we continue making cups, or do we go buy the cups from somewhere else and then maybe we're going to save money? So alternative one, what is the revenue of these? What is the revenue of the cups? How much are we making on the cups based on the problem? It's on page, I think it's on page 406. Does anybody have the book? Cayman, do you? Otherwise, I'll go get my book.
What was the question again that you were asking?
Can you help me with this problem on page 406? Can you read it so I can put the numbers in?
Yeah, so it says the condensed product line income statement for Dish and Dat company of the month for the month of March is as follows. And then so revenues, well, it doesn't give us that. It gives us sales, cost of goods sold, gross profit, selling and administrative expenses, and income from
Does
operations.
it say anything? Do you see a number like 31,300? If we continue.
That's for the sales of cups. Yes.
All right, good, very good. I'm trying to get rid of this thing. All right, so 31,300, that's if we do the cups. Notice there's no red star, which means that it liked that. Let's try to make it bigger. Let me see if I can move it over. How's that? Does that look good?
It's perfect.
Oh, great, I'm so happy. All right, so now if we don't do the cups, guess how much the revenue is going to be? Nothing,
Yeah.
0.
0.
All right, and here we'll wait. We'll do this last. That's like just basically an addition and subtraction. So, what are the costs of goods sold on the? What does it say about the cups? Does it say anything about 16,800?
Yeah, that's the cost of goods sold for cups.
What does it say? Say that slowly.
It says that's the cost of cups, like the cost of goods sold for cups.
All right, but does it say something about that 85% is the
So what we were given in the equation says fixed costs are 15% of the cost of goods sold and 40% of the selling and administrative expenses. Addition data fixed costs would not be materially affected if the cup line were discontinued. A says prepare differential analysis.
All right, so so did I hear you correctly? Did you say the fixed cost from $9,200?
No, so fixed costs are 15% of whatever the cost of goods sold are.
Oh, okay. So what's 15%? Let's see, 15% of 16,800. 16,800 times 15% equals 2,520. And what's 16,700? What is that? What is 16,700? Do you see that number, Cayman?
That's the selling and administrative expenses.
Okay, very good. So the selling administrative expenses are 16,700, but a portion of that is fixed. You know, there's a fixed cost portion, which is 40%, I believe. No, yeah, 40%. So we have to take. I wish I could write it somewhere. Let me put it in the box. So the fixed cost. Let's do those first. There's 16,800, right? Cost of goods sold times 15%. Someone tell me what that amount is. Can you type it in the box for me?
2,520.
Yeah, type it in the box. And then the selling, okay, good. And the selling administration costs, they give us the total amount, but we have to extrapolate 40%, which is fixed costs. So tell me what this is. Can somebody give me the answer to 16,700 times 40%? What's that number?
I got 6,400.
Do it again. 16,700 times 40%. Hendrik, can you help us?
Yeah, I got 6,400.
6,004. No, try it again. Oh, 6680. Okay. So 6680 plus 2520. How much is that? You got to add both of them together to get the total fixed cost. Good job. So we're going to put 9,200. And guess what? The fixed cost, no matter what happens, whether we do we got to do a minus. If ever you get a red star, always put a minus because usually that's what the problem is. So no matter what we do, whether we make the cups, we don't make the cups, guess what? The fixed costs are going to be the same. That's why they call them fixed costs. So notice I put the same amount with the cups, without the cups, and then the differential is 0. I'm just going to put 0 in there. So now the variable cost, see it says enter all costs as a negative. So the variable cost we said was 16,800, but we have to minus the 2,520 because that was given to the fixed costs. But we have to put it in as a minus. That's what I did wrong. Got to put that in as a minus. Parentheses. I'm just putting a minus outside the parentheses. Okay, so now it likes that number. So if we discontinue the cups, are we going to have any variable costs? If we're not making the cups, are we going to have any costs of making the cups? What do you think? Hendrik, what do you think? You think we're going to have any costs if we don't make the cups as far as variable costs?
No.
Yeah, 0, you're right. So over here is going to be, it's going to be equal minus this, minus this. So guess what? It comes out a minus, minus a minus becomes a positive. So this becomes this. And this one equal plus this minus this, I think. No, wrong way. Equal minus this. And then plus this, I think. Is that right? Yeah. So, all right. So we're going to have one more number to go. The selling cost. Okay, so instead the selling costs and expenses for the administrative were 16,700, but we have to subtract the 9,200, right? We have to subtract the 9,200. So let me just put a minus, parentheses, parentheses. Listen, you could do this on your own calculator, and then you can just put in the number. You don't have to do it like what I'm doing. Somehow it didn't come out right. 6,700. Let's see, what did I do wrong? The answer is 10020. That's the answer, but I'm trying to figure out why I didn't get it. Administrative costs were 16,700. And then we had to subtract. Anybody know how they got this 1020? Let's see. I took the 16,700 and I subtracted. Well, maybe it was, I don't know, 6680. That's what I had to subtract. So what do you get if you take 16,700 and subtract 6680? What do you come up with? Does that work? Maybe not. What number? Oh, you got 7820. No, that's not. I'm doing something wrong. I think this is how you do it. You get this is how you compute it. 16,800. Cayman, tell me what the 16,800 represents again.
16,800 represents cost of goods sold.
All right, let me just put it next to it. Cost of goods sold. Then you have to add that to, tell me again what 16,700 stands for.
Selling and administrative expenses.
Okay, I'm just going to put 16,700. I'm going to put S in it. What is it? Selling and administrative. S and A I'm going to put. And then that's times 40%. And that's how they came up with the 10,000 minus 10,020. Okay, that's how they got that. So now let's add all this up. So if we take 3130 and then we add all these minuses, what do we get? So So we get 2,200 negative, and then here, we don't have, I think, do we have anything? We have no selling and administrative here, because we didn't make the cups. The only thing we're gonna have sitting here is the fixed cost. The only thing that's not gonna change, whether we make the cups or not. Here, we're gonna have a positive 10,020. And then here, we're gonna have 0. So now here, we're gonna add everything up. A negative 3,130 plus this, plus this. So here's the differential effect, a negative 7,000. So they're saying the cup should we keep on doing it or not? What do you think? Discontinue or keep on making the cups?
Discontinue.
All right. And what about that would increase or decrease?
The
What's
cup
this?
line should be-
Don't guess. You've got the answer right here. What is this? An increase or decrease?
That's a decrease.
Yep. By how much? You've got the number.
7,000.
I think they want to put in positive. Good. Now notice there's a red star. What do you think that means?
Means it should be, the cup line should be increased
It should be retained, meaning,
or retained.
yeah, that's the word they use. So guess what? We got 100% up here. Does everybody kind of follow this, the PQ10, I think? How you doing with that? Is that good?
Yep.
All right, so if there's no other questions, I'm going to end this session. I'm going to stop the recording only because if I make it go on, sometimes it's too big.